Insufficient planning is quite often a reason for funds to fail or get delayed. Over communicating when you're doing this for the first time or when you're early on in your journey really helps to build trust. 3 specific things. One was, how do you exit from non-performing or low-performing assets? Secondly, it was about how do we monetize existing assets? Thirdly, how do we make new exciting investments?
I'm super excited for this week's episode of the Silicon Valley podcast. This episode has actually been, I'd say, a year in the making with travel schedules and this and that. But I think everyone here listening, you're going to go, oh my gosh, this episode was definitely worth the effort to put it together. So right now, I want to introduce our guest, Bijna. But before we dive into the questions, can you give our audience a brief background of your career up until this point?
Hi, Sean. Thank you so much for having me. And I'm really excited to be here. Absolutely. I'll give you a little bit of context. So my name is Bijna Kotak Dasani. I'm originally from the UK, which is where I started my career in financial services 25 years ago. You could say the first 20 years of my career were primarily focused on capital markets. So I was working with some of the well-known investment banks. I also spent a couple of years in retail and commercial banking, London, New York. Then I covered broadly the overall Americas region, North and South America, Europe, GCC. And then I ended up in India covering a mandate for Asia Pacific. And I was domiciled in India through the pandemic, which was interesting. That's really where my journey in the VC world started. Prior to that, I'd done some angel investing. I was very curious about how the VC and the PE private equity ecosystem operated, and really how it all sort of came together. So about 5 years ago, I joined the investment committee of a VC fund in India, and then the rest, as they say, is history. So sort of fast forward from there, I have now joined and had the honor of supporting and learning from about half a dozen VC funds globally. Mostly they are domiciled around the UK, India, and the GCC, but most of them have a global investment thesis. 1/3 of them are sector agnostic. 1/3 are focused on fintech, and 1/3 are focused on consumer and associated industries. So that is what led me here, and that's what I've been doing for the last 5 years. So it was a little bit by default, landed in investment banking thanks to a mentor, and then sort of a little bit more design in more recent years where I said, okay, this is very intellectually interesting. I'm curious. I want to go and do some further qualifications in the VC ecosystem to learn. And then I also want to practice through sort of delivery. And so here I am.
That's quite the journey. That's never shy away from a challenge there. The group that you're with right now, or help to be a part of, ArthAum Group. Did I say that correct? ArthAum Group? Can you talk a little bit behind the vision behind its founding?
Yes, absolutely. So look, this was part of my endeavor to learn and test. So we have, I had the privilege of working for a very reputable group in the UK when I left banking, where they have a very diverse portfolio of assets. And I was learning about 3 specific things in that ecosystem. One was, how do you exit and move away from non-performing or low-performing assets? Secondly, it was about how do we monetize existing assets across different sectors? And then thirdly, the focus was on how do we make new, exciting investments. And through that, I learned some principles and some methodologies, which I then, when I left that group, decided to plug into sort of my family's ecosystem and sort of our portfolio of things that my family does. So one vertical for me became sort of looking at exits and investments. The second then became the role that I had with the venture capital funds as an IC or board member, evaluating companies, having a vote and a say on whether we should invest in them, getting to know the founding teams, getting to know all of the different aspects of the kind of the company's thesis, their growth, their strategy, their history, and then sort of tying it all up. I found myself advising and connecting the dots informally for a lot of people, both in the venture capital ecosystem, but also in the startup ecosystem. And that increasingly took a lot of my time and energy away from the first two verticals. So eventually I decided to hire some team members and package it up as a way in which I could continue to do that, but in a more structured way, and put some credibility behind it in a framework. So we now have two verticals. The first is venture capital, where we have helped funds with going to market, figuring out their fund thesis, their launch strategy, and even connecting them to, we're not placement agents, but making introductions to credible, relevant people that could be board members or investors, so LPs. The second piece is venture partnerships. So that's where we focus on strategy, and we help companies that are going from, let's say, a Series A to a B to a C with diversification scale strategy. We evaluate them as an investor would. We decide whether it's something that makes sense from our portfolio perspective, but also if it's not relevant for us, we're very happy to sort of make introductions to the kind of the investors, institutional and individual, that I have in my network through the kind of VC work that I do. So really it became a test bed of learning, early due diligence, and then really having a solidified understanding of a company, its position in the market, and also how it functions from the inside out before making any recommendations to funds or investors or advisors in my network. So we now have a method to the madness, so to speak, and it's very, very structured.
Now, you'd mentioned something there about a launch strategy. Can we dive a little bit deeper on what a fund market and launch strategy is for maybe a first-time fund and maybe a consecutive funds?
Absolutely, absolutely. So look, launching a VC fund or a venture capital fund, whether it's a follow-on fund or whether it's a first fund, there are some key considerations and factors that are common denominators for both. We need to have a very clear investment thesis, first and foremost. We need to have a very clear operational foundation. And then we need to make sure that we understand the legal and regulatory landscape of the environment in which we're choosing to domicile or operate that fund from. So to have a successful or a clear fund thesis or strategy means that you need to have a very clear pitch. You need to have a realistic fund size that makes sense for your market and for your sector. And you also need to have a good team with a strong network. So let me break that down for you. If you're focusing, first of all, on the fund strategy and thesis, thesis becomes number one. You've got to be very clear. What are my target sectors? What are the stages of investment? Am I going to focus on seed, early stage, growth stage? What are the type of companies I will focus on? What will be the average quantum of those companies in terms of check sizes that we'll be putting in, what their valuations will be, the roadmap that they will be on. So that's really about your investment thesis, being very, very clear. Fund size and structure is then the second piece. So what is a realistic fund size based on the market research that you have done or the prior experience that you've got to say, okay, in this market, if I'm to domicile a fund, I need to be achieving X AUM, so assets under management, to be at least breaking even, and to making sure that my LPs and my investors have a good return or a decent return. You need to have something that validates your proof of concept. And then beyond that, we also need to figure out how you're going to structure that fund and which regulator you're going to structure that fund with. So, for example, you could have an umbrella fund, you could have a master feeder structure. For example, I've worked on a couple of master feeder structures in the GCC where, there are provisions around.
Now, could you talk a little bit about this vocabulary? I'm guessing some of our listeners have not heard before. Those two words you just said, master feeder and the other, an umbrella. Can you talk about what the difference of those two are?
Yes. So they are types of funds that can be created as portfolios of funds. So, for example, if I say an umbrella fund an umbrella fund can have many sub-funds underneath it, and then you can distinguish parameters around each of those sub-funds. If I continue with the example of the master feeder structure, one live example right now is a master fund that would exist, which would be the main fund for a group that was setting up the main fund in the GCC. That would mean that all investments can be made out of that master fund. The money would be paid from that fund into companies that they invest in. All of the reporting and the regulatory obligations would be at that master fund level. However, there would be mirror obligations that would sit with feeder funds. And the reason they would set up feeder funds, they would set up a feeder fund in the Cayman Islands for the Americas. They would set one up in India for Asia. And they would set one up in Luxembourg for Europe, is so that investors in those jurisdictions can easily transfer capital to the local feeder funds or the nearest jurisdiction feeder fund. And then the flow of capital goes up to the master fund. So it's really around reporting, efficiencies, regulation, and then limitations on what you can and cannot transfer capital into. So for example, this group has been considering a feeder fund in India because there are limitations on investors transferring more than $250,000 outside of India in a given tax year. So this is, they could transfer it into a feeder fund in India. They're looking at an economic zone, and then that feeder fund would transfer the capital up to the master fund. And even from a deployment perspective, you could make investments locally or at the master fund level, but most funds prefer to do it at the master fund level. So these are just ways of structuring your funds. You could also have syndicates. We don't need to have a special purpose vehicle that is just specifically for a jurisdiction. You could have a syndicate, which is where you want to start small. Maybe you say, I've never done this before. My first fund could be, let's say, a $10 million fund. I want to round up some friends that are investors I have invested with before. We have trust. I could do things on a case-by-case basis. So I could say, look, I'm going to bring in the first year maybe 3 or 4 deals. They're companies that I've already identified. I know I want to invest in them. I'm going to convince, my pool of investors to do the same with me. But I don't want to go through the strain of, launching a $40, $50 million fund. That's high risk for me. It means a lot more effort. I want to start small. And so therefore I may put together a syndicated pool of investors and start with a syndicate. And so some jurisdictions offer clear, options around created syndicated funds where you can start small and then you can scale up. So if that, let's say, for example, that $10 million fund does well and your companies are performing, you can then later apply for a license to turn it into a fully fledged venture capital fund. This gives you the option to invest deal by deal. So you can build your track record, you can stay flexible, you can get exposure to good deals without necessarily launching a fund, but you're operating like a fund. And then basically, you can build up your value creation and you can say, look, this is the track record that I've got. I now understand strategies around speed, control, liquidity. I've learned about the fund formation, banking, compliance, reporting, everything that's out there. And now that I have that knowledge, I feel a lot more comfortable to go and launch a full fund. So that is also another option.
Would that be the recommendation for someone that's looking to start a first-time fund, or would it be to be an analyst or associate or something at an existing fund? What would be the best way for someone that has that dream of being a fund manager to start from, say, nothing to get to that end goal?
There are many ways to cut and paste this. I wouldn't say there is there's a clear pathway. If I take, my career in capital markets, for example, it's different. You do an internship and then you apply for a grad role or for a master's role, and then you get trained and then you sort of work your way through the ranks and rotations. That's a very clear cut pathway versus this. I think this, if you're doing it, after a couple of years into your career, or you're taking a lateral move like I did, the first thing you need to understand is what kind of environment you're moving into. And then you need to understand how the ecosystem works. So I can give you my own example, right? I joined, I had some mentors, and then I joined the investment committee of a fund that was being formed. I performed as a member of that investment committee, and then I joined the investment committee of another fund, and so on and so forth. But while I was doing all of that, I decided to undertake some venture capital qualifications, because by way of experience, you pick up the terminology, the language, some of the things I've just shared with you. There's a lot in there. And if you don't know the industry or the ecosystem, it can be a little bit confusing and overwhelming. So I think learning and understanding the basics, whether that comes from mentorship, allies, getting some kind of, even if it's unpaid experience to start with, self-educating, whether that's through online modules or doing a formal qualification, and then figuring out what good looks like in the way of, a tailored, risk managed approach into a career, I think would be a sensible framework.
So say someone decides, okay, I'm going to go out and raise this fund. What are some of the mistakes that you see people make on that first time fund, whether it's their back office operations or, I mean, who knows? What are those mistakes that happen pretty commonly to first time funders?
Yeah, this is a really, really, really interesting question, and I'm glad you're asking it, Sean. So I've seen a lot of things take place in my sort of 5-6 years of doing this, and I have seen some funds do really, really well, and some unfortunately not take off, despite a lot of solid backing from investors and key names that are well known globally, kind of supporting them. We all have blind spots. And I think that when you're launching a fund and you have a team that has blind spots to some common mistakes during the launch or pre-launch phase, there are definitely learnings there. So I think the first one for me is the kind of the urgency of wanting to get the fund launched and just kind of jumping through all the hoops to get it done because you want it done in, I don't know, 3 months or 6 months or whatever it is. That is somewhere where I have seen a lot of people struggle because there are processes, funds are regulated vehicles. There are regulators that play a role for good reason to make sure that, risk and exposure are managed and the rest of the market is protected. And basically, it's important to take a step back, like with any project or launching any business or company for that matter, and having a clear direction and saying, okay, this is going to be my roadmap. It may take 6 months. It may take 12 months. I'm going to bake a contingency into it, but I'm going to follow all the steps. So the planning piece becomes really, really important. Insufficient planning is quite often a reason for funds to fail or get delayed. And so having a comprehensive strategy around attracting investors, around hiring talent, around understanding the regulations in the market in which you want to operate, around building relationships with fund formation teams and regulators, all of that becomes very, very important. The second thing I've seen is people with no experience in financial services whatsoever, trying to register funds and submitting documentation to regulators for approval for senior people that would be accountable to the regulators. So every regulator has a list of key roles and corresponding criteria around deliverables for each fund. I have seen a lot of ambition, which is great, but sometimes saying, you know what, I've got experience in the sector I want to operate in, know nothing about funds, but people around me are doing it, so I can pull it off too. That's very, very, very risky because you're exposing yourself, you're exposing your investors, and you're also exposing the portfolio companies that you would deploying capital to. So for the right reasons, the regulators have very clear guidelines and parameters on what needs to be done. In some cases, they would even interview and do detailed background checks on the people that are being named as, the senior members of that fund team. And so I think making sure that you find someone that has at least some experience or has previously been in a role where in their career, for whatever reason, they've been approved by a regulator or the regulator that you're looking for approval from, I think that adds a little bit of weight and gravitas to your application. So I think that's also important. From a fundraising perspective, I think there needs to be a very clear and diligent process around investor outreach. So having a pitch deck and just floating that on WhatsApp to a lot of people. First of all, a lot of regulators don't allow that until they give you permission to do so, given that your fund is reaching a certain stage in its application process. But even still, if you do it prematurely, you can be punished for that in some markets. But if you do it prematurely, and you just say, okay, I'm sending you my pitch deck on WhatsApp, commit an amount to me. I know you, you're a good investor. And assuming that that is an LOI, so a letter of intent, or assuming that that is actually a commitment from your investor and putting that into your fund plan, again, it's a little bit naive and it's not thorough. So everything needs to be documented. You need to get the right legal and operation support. You need to make sure that capital is locked in a proper way through agreements with investors who would be your LPs, so your limited partners. You need to make sure that open, ongoing, and consistent communication is occurring regularly with actual and potential investors on an ongoing basis. And I think, that corresponding to also updates on where you are with your fund formation and appropriate due diligence is really, really important. And then the other thing I'll say is due diligence is also necessary for your investors. If you are taking capital, let's say I want to launch a fund tomorrow for $50 million, and somebody comes to me and says, okay, Bijna, hey, Sean, I'm a friend of both of yours, and I have just closed a transaction somewhere, and I've got 50 million lying in the bank. Give me a LP title on your fund, and I will give you the full amount. Great. And they can probably evidence that they've got the money in the bank and show the regulator, but you need to be very clear on source of funds because that is something that the regulator will most likely also ask. So then I need to go back and say, okay, Sean, this person is our friend, but what is the absolute source of funds, right? So I know they sold a building and they made 60 million, of which they're giving us 50. But really, who paid them for that? Where did it come from? How long has it been sitting in that bank account? I really need to get someone on there to do kind of an audit and due diligence because ultimately when that capital comes into my fund, I will be responsible for answering to the regulator and to the market. So again, you can't over rely on investors. You can't rely on trust and gut instinct beyond a point. You've got to be diligent. You've got to be tying up everything with the right administration. And you've got to be taking counsel from most regulators have a guidebook that they would issue online. You've got to be taking absolute guidance from the regulators' principles and guidebook to make sure that you're following a diligent process so that later on your fund or you or your reputation as an individual does not come into question.
So a couple questions right there. The source of funds, I'm kind of curious with crypto right now. I'm guessing that's probably come up with a couple first-time fund founders of, hey, I have one investor, he has crypto, he'd like to invest. I'm not quite sure where that's coming from or that. I'm wondering, one, has that come up in what's normally the solutions? But even before that, the preparation for one of these first-time fundraisers, how long should the people plan? Is this something that they should plan to get done in a few months, a year, 2 years? What's a realistic time expectation?
So I'll break that up into three segments. So the first around crypto, I have seen transactions close in the real estate sector with crypto and associated, vehicles in the last 6 months. And I think there's an evolution happening there. But I've also seen things go pear-shaped because of some of the risks that sit around that. From a fund perspective, I have till date not experienced firsthand any funds that close investments through a cryptocurrency. I've only seen clear, traditional, kind of cash in the bank type transactions happen so far. So that's the first piece. I think we will see an evolution, but we're not, at least globally, what I'm seeing, we're not there yet. In terms of the timeline to prepare, I would say you've got to give yourself 12 months, give or take. I think if you try and rush it, you risk being exposed to something. You put too much pressure on your investors. They will also get annoyed. They may go somewhere else thinking, why are you putting so much pressure on me? Because even I want to do my due diligence on you as a fund or you as a GP of a fund before I commit my capital to you. I want to understand what the term sheet for an investor looks like. I want to understand what the return on your fund would be for me versus other investments I'm making. Equally, for the marketing side for your fund, you've got to wait for the permission to be able to do so, hiring the team, going in front of the regulator, having the interviews, to and fro with the regulator. Sometimes some administration companies will say to you, okay, hey, typically it takes about 4 to 6 months for the regulator to process your application. But I know somebody that's sitting on the inside. So I have a friend, I'll call a friend and I'll get it done in 3 months. Anybody that tells you that is most likely not going to be able to deliver that, right? The regulators work through a process with diligence for a reason. It might be that, yes, they have got more staff and they're automating and they're able to get through the caseload quicker and you can get it done in 3 months. But typically, I would say 3 to 6 months just for the regulator piece. And then you need to give yourself 3 to 6 months before that for the planning, hiring, prepping your application piece as well. You also should be aware that a lot of regulators will outsource to third parties to do enhanced due diligence checks. So, for example, I'm aware of a situation in the UK last year where the founder has a fantastic background, but he had invested in a company where that company unfortunately had entered into some financial difficulty, and he was named on the cap table of that company. And that company that he was an investor in, entering into financial difficulty, was flagged to the regulator. Therefore, the regulator would not allow him to register his fund until that entire thing was cleaned up by the company that he had invested in. And it wasn't in his hands, right? That was a separate entity. He just, invested thinking that he'd get a good return out of good faith. And unfortunately, he then became part paralyzed for his own fund launch because of that. So there are multiple things that could come up and be variable factors in impacting your journey. And I think just having a buffer period, understanding some of that is really, really helpful. And could save you a lot of pain sort of through the journey.
One, I'm definitely curious about some fun launches that you've advised and what made them successful. But I'm also curious, maybe even before that, I think more of a better order of questions is, can you talk about the process of fund operating administration from start to finish?
Absolutely. So I work with and have some really good relationships with fund operating administration teams in different parts of the world. The positives that I have seen across all of them is absolute professionalism and clarity in terms of what the timeline and the process and all of the steps look like in that process. So if you, for example, appoint somebody to do your fund formation exercise for you, the first thing they should do is sit with you and just show you the mirror. Right? Play devil's advocate in a very professional way and say, okay, I understand, Sean, this is the type of fund you want to launch in this market by this point in time. Have you considered A, B, or C? Or are you aware of certain legislation that's coming in that might impact you? Or have you got a provision for, let's say, a geopolitical event that's looming in the background, right? What is your overall plan and strategy? So at least having one solid conversation around that is really, really important. Once you get through that and you are aligned that you are thinking about everything that could be a blind spot, or at least as much as you can preventing or protecting yourself from known exposures, you then move into the process of appointing someone to do the fund formation for you. That will give you, effectively, it's quite often like just a tracker in some sense of the word. But this is the next kind of 3 to 6 months. These are the 15 or 20 things we need to get done in sequential order between us and then between us and the regulator. These are the approximate timelines for each of those steps. This is what's needed from you. This is what will be done by us. And this is how often we will need to communicate to make sure we're on top of things. So, for example, I'm working with a group who I was with in person a few months ago. And, to kick off the fund formation, we needed to submit all of our personal documents. So it's really important that as a team, we provided all of our qualification certificates, our residential status documents, tax status documents, everything to the in-house legal team so that they could put everything in a consistent format and provide it to the fund formation team. They then took everything for all of us as a team, and then it's their job to go to the regulator and say, right, these are the individuals. We've done our initial vetting on them. Now we're submitting to you. And then the next stage is, as they submit to the regulator the framework of what will be the roles and responsibilities of these individuals, they also go and do their own background checks on us on behalf of the entity that would be the fund. So then they go and check, have you ever had, I don't know, a speeding ticket or a criminal history or anything at all that would come up later that would make you, sensitive to the processing of this fund formation exercise. So that's one small example. What's your career history, et cetera, et cetera. So you submit all of the artifacts that are needed on an ongoing basis. You have a very fluid relationship from a communication perspective. You go via the fund formation party. The fund formation party works closely with the regulator. And then there's a lot of to and fro as you get through the process and you guide each other. If you have questions, you kind of work through them as they go along. But the whole idea here is that it's a very structured, standardized, for the most part, process with the variables being addressed as they occur on an ongoing basis.
Bijna, this structure, this process with the regulators, what countries is that for? Is that for basically the globe? I'm kind of curious where the regulators are highly involved.
Okay, so it's pretty similar globally, but not the same, of course, depending on the market, the maturity, etc. My experiences that I'm talking to are specific to the US, the UK, Europe, India, and the GCC regions, and Singapore.
Perfect. And now, can you talk about an example of a fund launch that you advised and what made it successful?
Absolutely. So without naming the fund for obvious reasons, there is a fantastic fund that I have been advising for several years now. And I can tell you some of the things that they have done really, really well, not only to get the fund off the ground, get the investors in, but to get extra commitment from the investors on an ongoing basis. And the fund has ended up with a additional, corpus that it wasn't really anticipating earlier, just because they have been so professional and diligent in their approach. And, that sort of reputation that they've built up from the beginning speaks volumes. So they started with a thesis, a strategy of here's an opportunity in the market. This is the sector. This is the geography. Let's start small and then let's scale. And they were able to close the first round very quickly with an anchor investor and some private investors. They were then able to, rather than some funds may sit on that money because it's the first time they're doing it, they're nervous, they want to take a lot of time around due diligence. They didn't take time after setting up the fund. Whilst the fund was being set up, they started to, identify companies that could be potential investments for them. In parallel, hired some people and started to get the due diligence and the evaluations done. So by the time the first close was announced and the fund was legally registered and ready to go, they were able to present their first investment committee. They were able to say, okay, these are the shortlisted companies for these reasons. These could be the potential returns. Of that, one investment was made. And then 3 months later, another investment was made, and so on and so on. So as that started to happen and the company started to perform well, there was more proactive outreach from investors to say, actually, you guys are doing a really good job. You're not operating like a first-time fund. And they were a first-time fund. You're actually operating in a more professional way than funds that are second, third-time funds. And also in parallel, they kept the investor communications very, very, very structured. So there would be a newsletter that would go out monthly. There are WhatsApp communities where updates are being shared in a consistent fashion. Really good posts online on LinkedIn, on their website around what's happening, where they're investing, why the portfolio company is a good bet, showcasing the portfolio companies. And then also having investor days where the portfolio companies are invited to come and meet the LPs and the investors and say, this is how the capital injection we've received has helped us. So you could say it's helped us, hire a leadership team, or it's helped us get more equipment, or it's helped us, set up an office in another country. And therefore the direct impact of that investment is X, Y, and Z. So I think over communicating when you're doing this for the first time or when you're early on in your journey really helps to build trust. And then what it's done there is it's helped not only build trust, but it's helped build an interest in investors saying, we're going to bring other investors to the table. And also we would love to back you a little bit more if we can. So your track record as it's happening starts to speak for itself. You end up with a very collaborative community of supporters. You indicate that you've got professionalism and credibility, and you stand out. So even through some of that storytelling, right? You stand out, you appear different to other funds where they may take your capital, but you may not hear from them until kind of an annual investor report or a semi-annual investor report is sent out via email. So I think all of that really, really helps. And then, diligently investing in the relationship building, having strong due diligence, being open to and asking people to show you the mirror and saying, look, I'm thinking about this. I'm not sure, can you give me your opinion because you've worked maybe, let's say, in the part of the world that one of these companies wants to grow into, and having those open, authentic, real conversations. That is what helps you build a network of allies. And then, you are slowly and gradually establishing your reputation as almost best in class, versus the other, let's say, X number of funds that may have formed servicing a similar sector in your market in that sort of time period.
And how important is it to leverage a global investor network to raise capital? And I guess, how do those first-time fund founders attract LPs without having a track record?
So it's very important to have a global investor network because I think we are living in very, very interesting times, and to narrow down your investments from just one market can be perceived as risky in the geopolitical climate that we're in. So diversification strategy is absolutely important, albeit even a small percentage, but it's important. Okay, that's the first thing. Secondly, in terms of that kind of strategy and that approach, if you're a first-time fund and you haven't got a track record of doing this before, your network presence, your network penetration as an individual and as a team or a member of a team becomes really, really important. The only reason, in my experience, that investors will look at a particular fund is if the thesis stands out or if the thesis and the people stand out. It's about the relationships. So, for example, with a lot of the funds that I have worked with, and actually I'd give you some raw examples. In one instance, very early on when I started to do this, there was a very credible individual who wanted to lend their name and their brand to a fund, but wasn't going to be involved in the fund, but wanted to create a fund for a specific sector, which, was kind of new and emerging theme at that time. We socialized in the market the idea about the fund, his brand values, his kind of credentials and credibility. A lot of investors saw right through it. They were like, no, unless he's actually going to be on the exco, unless he's going to be playing an active role and be in front of the regulators, we're not investing, because he could just be taking a royalty from this fund for all we know. So if the fund is talking about his value system and the fund is talking about his career credibility in his respective sector, we need to see him actively involved and at the table with conversations with investors. So that was one piece, because these investors are generally quite sophisticated. The other piece that was a little different, but also a learning, was where there was a team that had never run a fund before, and we're doing it in one of the technology verticals, So new relatively in the grand scheme of things, emerging, some risks, a lot of hype. But again, investors are very clear on distilling the fund thesis to say, look, there's a lot of smoke in this sector. How are you really going to focus on value creation, tangible value creation? What does that look like? And the founding team of GPs were really, really credible. They'd never done this before, but they had all had very senior roles in their career in corporate organizations in different parts of the world. They had been in positions of influence and power. They had, the authenticity to talk about difficult situations that they had navigated, what their learnings were from the things that didn't go so well, and how they were bringing that to the table in this conversation. And really what they were going to do in terms of combining their experience and their network to bring investment and value creation to the fund. And, a lot of people were very happy backing them because they felt that there was a very balanced but strong team there. So I think it really depends on your network presence and penetration, but also the authenticity that sits around that and the ability to convince investors that the team that you have is going to be able to deliver with integrity all the way through.
And how do you see the venture capital and partnership landscape evolving over the next 5 years? And what differentiates your group from the other venture capital and partnership firms?
Yeah, so over the next 5 years is a very interesting question because we are living in very, very, very interesting times. The global VC investment trajectory it's growing year on year. There's a particular focus, for example, this year and next year, trending towards sustainability, healthcare, AI. The number of deals overall may be decreasing, but we're seeing larger mega deals, which is something that we haven't seen of certain quantums, in recent years. So overall, investment value is going up. And we are seeing dominance across sectors and industries through technology. So again, I'll go back to AI. It's the application of generative AI in various industries is actually pushing a lot of investment. That's been the case for a while. Green technologies, climate tech technologies, ESG mandates, depending on which part of the world you're in and kind of what ESG means to you, are weaving into government priorities. And again, that's driving investment and focus. Digital healthcare, I think, especially since the post-pandemic era, personalized medicine, telemedicine, biotech breakthroughs, we're seeing a lot of that powered by technology. And really then what we're seeing also is new VC hubs cropping up in different parts of the world, or we're seeing VC hubs taking stronger shape in different parts of the world where, governments are saying, okay, there are so many new startups in a particular, let's say, ecosystem. Let's just take healthcare innovation, for example. There are so many new firms cropping up. There are so many new propositions. This requires investment. So let's create policy and strategy to do that, to enable investors and VCs to come and have a structured format where they can test, learn, play, and invest. And let's create some homegrown, unicorns or whatever it is that they're looking for. But ultimately, a lot of governments have strategies for the next 5, 10, 15 years where there is an opportunity now through, consolidated practices around venture capital to invite investment and to invite, creation from the startup ecosystem. And then sort of marrying the two to say, please go drive value for this country or for this geography. And we will make sure that we plug in the levers to support you. So I think that is really a growing trend year on year. We're seeing it in different parts of the world. And I think that's going to continue for the next 5 years for sure.
In your group, what separates you from all the other venture capital and partnership firms?
So we are very different in that we started for the learnings that I was looking for. And then we ended up bringing together ecosystems of networks and partners in a very organic way. So we didn't really set out to commercialize this for the market and scale in the way that we have. So just in the last couple of years, we've scaled from a geography perspective. So we're now working on mandates from North and South America all the way through to Australia. And then even from a sector perspective, I started off with fintech, and then we advanced into technology and AI, more broadly. And now we're playing with real estate, infrastructure, biotech, pharma, hospitality. It's really, really become very diverse for us very, very quickly. And I think what is a differentiator for us, basis feedback that I'm receiving regularly from groups that we are working with, is that we are very structured. So although we started off as a very small group doing this to really try and understand the market and to create value by supporting as venture partners, and I think this partly goes back to the fact that, I've been trained in a very diligent environment for 20 years in capital markets. Everything is by the book. You're taught to be audit ready at all times. You're taught to have a lot of processes. So even when we were starting this, for me, it was important to have a lot of in-house legal and ops people before we even hired the full investment team or the venture partnership team. So we have a lot of processes. We have a lot of structure. And what we get told is that companies, even if they're sort of like it's sort of Series A stage, they like being, treated with the protocols and the respect that you might get, and the provisions that you might get, let's say, even if you were a Series C or if you're going to IPO. And that also inspires them to get their house in order because we help them, kind of look at exposure risks, and then kind of build up. So fill in the gaps and then kind of build yourself up and scale and diversify. We also have a global team. So I think that also helps in that we're able to, there's a pro and con to everything, but the pro here is that we're able to provide, very, very diverse perspectives and very broad networks as well, given that we've got team members sitting in different parts of the world and they come together and they ideate for a particular client and say, okay, there's something that's happening in, let's say, South America, but we know of something over in, in let's say Singapore that could be a perfect fit for that client. And we sort of marry the two and are able to help them generate value. And they may never have considered that because it's so far away from what they're focusing on. But everything that we do is purely through network, and all of the work that we are undertaking is by referral only. So it's an interesting place for us to be. We're still learning, still growing. But this is some of the feedback that we have received.
And if any of our listeners or anyone wants to get in touch with you and find out more, what's the best way to go about doing that?
You can come to our website, you can come to our LinkedIn page, or you can even get in touch with me and my team via bijna.com.
All right, fantastic. We'll have that information in the show notes. And with that, Bijna, I got to thank you for being a guest on this week's episode of the Silicon Valley Podcast. I learned a ton and we covered a lot of information that I'm sure our listeners are going to have to listen to this episode 2-3 times to really grasp everything that was said. And for our listeners out there, well, I'm not the host of the Silicon Valley Podcast. I'm an investment banker. Connect with me on LinkedIn at Sean Flynn. And for our listeners, if you want to check out our archives and what we're working on, go to thesiliconvalleypodcast.com. And with that, Bijna, I want to thank you one more time for being a guest on this week's episode of the Silicon Valley Podcast.
Thank you, Sean. It's been a pleasure.